Hi everyone, it's your daily 10-minute business and finance news wrap for this Monday, the 5th of July 2021. Later, Sydney Airport at the centre of a huge $22 billion takeover offer. But first, let's talk jobs, because the number of jobs advertised to be filled continues to rise. The ANZ job ad series increased 3% month on month in June. That means there are 211,854 jobs up for grabs. ANZ says as a result, the unemployment rate has a lot further to fall, even amid the latest lockdowns. For more, here's ANZ's senior economist, Catherine Birch.
The June ANZ jobs report was covered during the Victorian lockdown, and yet we saw job ads actually increase by 3%. And that's a really good sign for other areas that are currently in lockdown in Greater Sydney and other parts of New South Wales, WA, Queensland, Northern Territory, because the recent history does show that with these short, sharp lockdowns, we usually see activity bounce back quite quickly. So even if some workers stood down or even laid off, they usually find work again pretty quickly, or they're reinstated very quickly once restrictions ease.
ANZ's Catherine Birch there. Now, no doubt the lockdowns will be one of the things that the Reserve Bank Board will consider when it meets tomorrow to discuss interest rates and a potential easing of economic stimulus. We'll find out tomorrow more. That's probably one of the reasons why the Australian share market didn't do much today. The 200 at 7,315, that's a rise of just 0.1%. Energy stocks rose as OPEC Plus suggested oil output may rise. The banks and technology stocks led the decline. But the big winner today, Sydney Airport's 34% stronger. That's because it received an unsolicited takeover offer. For more on that and more, I spoke earlier with Sherwood from Perpetual, and I first asked him about the impact of lockdowns on the share market.
It's already having a fairly significant impact on markets. It's kind of sat markets of the strong upward momentum, particularly outside of the US. Markets were very aggressively priced for a very strong economic recovery in the September quarter. And whilst that is still likely, it's the level of the growth surge, which is probably going to come in below expectations. Initially, it was going to be driven by lower inventories. Now there's evidence mounting that the supply shortages of components are starting to impact activity. It's starting to impact consumer behaviour. Their precautionary savings is more likely to remain elevated than spending the stimulus they've been given in recent months.
I think the big event for the markets will be tomorrow when the RBA meets. What are you expecting? And do you think the RBA governor will at least address the latest COVID spread in Australia?
I certainly have no doubt in the minutes the board will make comments of their view of of the Delta variant surge in Australia. But I think the major news, there won't be anything surprising in those comments. But we tend to think that the bank will pull some of its accommodation, so there will be another round of quantitative easing or asset purchases. But it's probably going to be less than the two $100 billion programs the bank has already implemented. We think it's likely to be around 75 billion, and it's probably going to have some flexibility around it, around monthly purchases, how long it lasts, and it might even be state-based. In other words, given certain developments, the program may diminish or increase its rate of purchases. At the same time, we think the yield curve control will not be extended beyond the April 2024 bond. But both of those announcements are probably going to have more financial market implication than that for households. Given the governor's tying future rate decisions to wages growth being at or above 3%, I think Australian households can relax for a couple of years that the bank is not going to be moving the cash rate, and we suspect the RBA is going to be one of the last major central banks to increase rates, and that is likely to still occur in the second half of 2024.
And I guess the big finance news story of the day is this $22 billion bid for Sydney Airports by a consortium led by IFM investors. It's just one, though, of a number of infrastructure bids or moves in Sydney in particular. Why the interest?
Oh, well, Australia generally is a nation of duopolies, and Sydney Airports, of course, dominates foot traffic into Australia and really across Australia. And as such, that asset has a lot of features that investors would find fairly attractive at this stage. But really, the key for investors is not really the earnings footprint or anything like that. I think the key now remains valuations. And at present, these types of assets are trading on multiples, which suggests that they have almost risk-free cash flows. And I'll give you the tip, they actually don't. And we've actually seen that in the last year, where the foot traffic from global travellers into Sydney Airport, for example, has fallen by 96%. And even domestically, things are down by 70%. And of course, with the Delta variant still there, we're not really sure what kind of outlook air travel has at this stage, particularly with increased use of technology for interstate meetings and so on. So, those valuations are very rich at the moment. There is risks around these cash flows, so investors have to be pretty wary of being willing to pay too much for an asset that may disappoint in coming years.
Matt Sherwood there from Perpetual. That is SBS On The Money. Don't forget, you can listen to this as a stream or podcast on the SBS radio app, Spotify and Apple Podcasts. And for more, watch SBS World News, the On The Money segment from 6:30 p.m. on SBS weeknights.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice, and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.